Today on the HyperFast Wealth Show, we have an amazing guest who has bought thousands and thousands of real estate mortgages and has created a vehicle to pass on the benefits of these great deals to the masses. I'm excited to have Paul Birkett on the HyperFast Wealth Show. All right, welcome to the show. How are you doing today, Paul?
Doing pretty great, thanks. How about you?
Great. So I'm back in Florida after spending a few weeks in DC for our big real estate event. I understand you're calling all the way in from Dublin, Ireland, right?
That's right. I'm from Ireland originally, and I'm just over here taking advantage of the remote working opportunities and doing a couple of weeks from Europe.
Great. Well, we've got a lot of great stuff to talk about, including what you think will be a massive opportunity in distressed assets, distressed debt, and some of the stuff you're doing to help people, with very little money, get into that area and take advantage of that. Before we jump into that great stuff, why don't you tell the HyperFast listeners a little bit about your background and experience and how you got to where you are today?
Well, this is my second act. My first act was 25 years as a corporate executive working for Fortune 50 companies all around the world. And I got to the US in 2010, just after the last real estate crisis, and saw that you could buy a 3-bedroom, 2-bathroom home in Florida, for example, for $70,000 or $80,000 and rent that out and generate $10,000 or $12,000 a year. And I just thought that was the most unbelievable opportunity and started buying homes and got up to about 20 and thought this was going to be passive income. But anyone who owns rental homes will tell you, once you get past 5 or 6, it becomes a fairly serious job. And so I ended up with about 30 rental homes, but was unhappy because I was spending all night and all weekends doing admin work to try and keep on top of repairs and all of that kind of stuff. And so I was buying a short sale from a major bank in the Northeast, and that short sale became a note sale, a mortgage sale. So I ended up buying the mortgage rather than the home. And that blew my mind completely, because in Europe, the only person who can own a note is a bank, and I'm not a bank. And so that was 2014, and since 2014 till now, we've managed about $200 million worth of mortgages, and I've just built it up year after year after year, and do that with a staff of just around 10 people in total, and much more scalable than trying to manage rental homes, more profitable too.
Yeah, you brought up a couple of interesting points there. It was like, one is you can invest in the debt, and then two, what led to that, your frustration with the time it takes to manage rental properties. And this is why, you see the people that scale and do that at mass. At some point, they have to hire a management company or create a management company to do it. Otherwise, it really is not passive income. Like if you're one of these landlords that only owns a handful of units, right, and aren't big enough to take advantage of a management company, it's a lot of work. I mean, it's a lot of your time.
Correct.
So are you with what you do now, has it created the same type of income and wealth building, but just with a lot less of your time?
Well, I work pretty hard. So what it does is it allows you to manage at much greater scale. I mean, for 10 people to manage $200 million of rental houses, that would be next to impossible. But with mortgages, what you're managing is really the borrower and the payment stream. So if the toilet breaks, the homeowner fixes the toilet. They don't call their bank and say, "Hey, Mr. Mortgage Guy, can you come round and fix my leaky faucet?" So you're just much more focused on different things, and that's a lot more scalable because you need to be expert at a smaller group of things as opposed to a handyman, an accountant, a tax expert, a property preservation person, a rehabber, and a little bit of everything. So the mortgage business much more scalable and, in our view, much more profitable.
And is it, a lot of people get into landlording and rental, by going out and buying one home, right?
Yep.
And something
Yeah.
anyone can do. And I think they're comfortable with it because maybe perhaps they've bought a home for their own personal residence first. Is that type of approach possible for the average person out there that's like, you know what, I like what Paul is saying. I want to go out and buy a mortgage or a note or lend on this property. Like
Well,
how would that work?
yeah. Well, 50% of rental homes are owned by people who own just one rental home. So what you're saying, Dan, is completely correct. They bought a house, they live in it themselves. They bought a second one and they rent it out. And that's a nice plan. Over 25 or 30 years, you pay off the mortgage and you've got cash flow for your retirement, and that's terrific. It's a little harder to get into the mortgage business, insofar as you need a bit of licensing and you need to be pretty expert in certain areas. And many people I talk to get into it, and they don't really have too much business getting into it because they don't know enough to really be doing what they're doing. So what we did to help people into the industry was launch a fund. And what the fund does is it pays an 8% preferred return to the investor. We do all of the work. And if you go back to 2014 up until today and just average our returns, we've made about 16.5% a year. So the way it works is we take 8% or so and put that into running the business, and the other 8% goes to the investor. And we pay interest monthly, or you can decide not to take a check each month and roll up that interest and get interest on the interest. And so we find a lot of people put money with us while they're waiting for example, the idea you had of buying a rental home. Well, that might take 6 to 9 months to get the money together to do that. We offer best efforts liquidity. So that means you can put your money in, and if you want to take it back out in a few months, provided we have the cash on hand to do so, we'll return your money to you with your pro rata interest paid for the period that you were in the fund.
And is there, you mentioned you were getting returns in excess of 8%. Is do the investors, who invest with you, do they have a shot at getting above 8%, or is it fixed for them at that?
Yeah, it's our target return for them is 8%.
Okay.
The other 8% goes to run the business, because when you buy the loans, the borrowers typically are not paying. And the way we get them paying is by calling them up through the loan servicing system to get them back on track. And we take those cash flows and, in broad terms, we split them with the investor. And so that's how we generate those returns.
And you're able to have this kind of success, I'm guessing, because you're buying these mortgages for much less probably than the people owe on them. Is that correct?
Yeah, if you give a typical example, let's say the home is worth $100,000 and the mortgage is maybe 120 or 130,000, and that's why the borrower stopped paying, because they think, well, if I owe 130 and the houses are only worth 100, I'm really losing 30 grand here. I'll just let this home go into foreclosure, or I'll maybe do a short sale. And what the bank will often do is sell us that loan, and they'll sell us that loan not for 130,000, which is what the borrower owns, but maybe 60,000. And so we've now got the difference between 60,000, which is what we paid for it, and 100,000, which is what the house is worth. So there's 40,000 there to work with the borrower. And what we'll do is typically talk to the borrower, find out why they stopped paying, and agree a new payment plan with them that reduces their payment, reduces their interest rate, and extends the term of the loan so that their monthly payment is about the same as rent, or maybe even a little less than rent, so that they can actually save money by staying in their home as opposed to letting it go to foreclosure.
Gotcha. So you're providing liquidity to the banks, and they don't specialize in what you do, so then you're able to go in and help these borrowers stay in their homes, not foreclose it. Like, it doesn't sound like you're in the loan to own business, so it ends up being a good deal for the homeowner.
Right.
And then because because you bought that note at 50 cents on the dollar, you're able to get these double digit returns on them.
That's it. It's as simple as that. And then it's a matter of doing it at scale and making sure that it's compliant.
Yeah. So how do you scale that? Like, how do you find these opportunities, and where are you finding them? Is it kind of all over, or in certain geographic areas?
It's all over, but typically where you see in the news, let's say there's been a big problem with COVID, for example, in all the tourist destinations. So in Florida, there's been a big problem. About 2 to 3 months later, you'll start seeing non-performing loans coming to the market. Because as you said, Dan, the bank is in the business of making loans. They're not in the business of working out problem loans. They don't have that expertise or those systems. So they typically will sell those loans. And so I spend 80% of my time looking for banks who want to sell loans. And it may be a year from the day I first talk to a bank to the day we buy a loan from them. It's a very long courtship process. And the reason it takes so long is because the bank wants to make sure they're selling to people who will treat their borrowers well. They typically don't want to sell to the loan to own investor, because that's going to result in a foreclosure and a homeless family. And that's a headline risk for the bank that's selling the loan.
And are you finding most of these loan deals through personal relationships, or is there a marketplace for them as well, or how does
Yeah,
how does that work?
in the early days, it was all through brokers. There are loan brokers out there. It's an unusual industry. There aren't too many people in it. And we would buy a lot through the loan brokers. But just like any other business, over the years, you start to build up personal relationships. And I'm pretty well known in the industry. So people sometimes come to me. In the early days, I was making a lot of phone calls and getting a lot of no's. But after 8 or 9 years, people start remembering you, and from time to time they call us, and so that will result in a deal right there. So it's conferences, it's outbound phone calls, and it is the broker channel. That's really where these loans come from.
Okay. And what's your outlook right now? I mean, I know you kind of mentioned COVID, vacation spots. Where do you think the market for these types of loans is going in the next 6 to 12 months?
Yeah, I think we've got a very, very tough 12 months ahead. We mentioned earlier the people who bought a single home to rent out. Many of those are struggling to collect some rent or any rent from their tenants, because many renters are also working in the industries that have been hardest hit by COVID. Travel, leisure, hospitality, those folks tend to be renters rather than owners. Well, if the mortgage is not being paid by the rent from the tenant, then there's a good chance some of those homes are going to move into foreclosure. And currently there are approximately 2 million loans across the country in forbearance or more than 90 days late. That's a lot of homes. And we will see 1 to 2 million of those likely entering foreclosure in the next 6 months. Not all will finish foreclosure, and by that I mean people like us will buy those loans and rehabilitate them. But I do think there's going to be a large wave of non-performing mortgage loans in the market in the next 6 months. And that's why we launched that fund to work with people to buy those loans.
And where where is it normally? So you mentioned 2 million,
Yeah.
but just to give people a barometer, like, where was it a year ago, or where do you typically see that number at?
Well, typically 1 to 2% of mortgages are more than 90 days past due, and it could be 7 or 8% by the time we get to March of 2021. That's what our model suggests. And if you think of the last crash, that was in 2011, was the peak of foreclosures, and that was 10%. So it's not quite as bad as the last peak, but it's still a pretty significant number of homes. The big silver lining for a lot of borrowers, though, is that there weren't the crazy lending standards that we saw in 2005, 6. And so now households have a lot less debt than they had way back then. But that's still a big issue, which is there's still going to be payments that need to get made. And people who are out of work are not going to be making mortgage payments, not going to be making rent payments. And so that's going to be an issue. In terms of geography, last time it was all the expensive cities. So New York, San Francisco, Chicago all had big spikes in delinquent mortgages. This time it'll be the same, but also places like Florida and New York, New Jersey, across the Rust Belt. I hate the expression, but those states have always struggled, and anytime there's a recession, it hurts them, and that tends to translate into non-performing mortgages. And so I think we'll see something similar again this time.
Yeah, that's kind of an interesting point about the Rust Belt. I've never thought of, like, it's really not like the best name you could probably come up for an area. But that's kind of an interesting point. But you think this time anyway, you'll still see some of those big cities, especially the ones people are leaving, like San Francisco and New York,
Right.
take a hit, but now maybe more the vacation spots, or yeah, it sounds like more middle America might be feeling
Yeah.
some of
I mean,
this.
if you're running a chain of restaurants or you're running any hotel, lodging, hospitality business, you're probably worried about the future. And if you work in any of those industries, you're probably worried about the future. And if you're in a beach town, it's probably not going to be a great tourist season for 2021. And all of those, there are problems that need to get solved. And the best way we've come up with solving them, unfortunately, is the foreclosure process. And the real challenge is, how can you get through that process as quickly as possible and as painlessly as possible? Our angle is to restructure the loan. But there are those others who want to actually get to the real estate, and you see that a lot of that stuff on the fix and flip TV type TV shows. So that's not what we do, but from time to time we end up with a home back that we have to rehab and sell. We've taken about 60 homes back out of the 2000s that we've processed so far.
Yeah, I mean, you're certainly more the expert in this area than myself. I only have just what I've seen, and luckily we're in the DC market. We don't seem to have had the same effects that other big cities like New York and LA and San Francisco, may have
Yeah.
had. And I don't know if that's just because the federal government is propping up the job market there more than others, and I've also seen this stats that depending on your price point, that really is going to determine, are you affected. And like in my particular market, most of the homes we're selling are like 600K,
Right.
and that's pretty hard for someone on not making at least 100K, I think, to afford and buy. So most of them don't. And like in the DC market, it's restaurants, retail, that are the type of jobs that are hurting, which the people, it seems like a lot of the people that are making six figures are getting to work from home, and actually almost are in a better spot depending on who their employer is. If it's the federal government, it's pretty safe
Right.
bet.
Well, there's been a lot of talk about a K-shaped recovery. Those with 100 grand jobs and above are doing just fine, thanks. And yeah, they get to work from home, and that's fine. But those who are in service businesses, they're really hurting, and they're not seeing any recovery at all. Um, and so, that's going to have to play out over the next while. And we'll just have to, see what happens. But super low interest rates really help the real estate business and the real estate world and the economy generally. Let's see if it can pull us out of the current malaise that we're in.
And do you think your company's specific opportunities, will it be in the homeowner that owns some rental properties, single family home rental properties, or will it be in apartment buildings or smaller, multifamilies, or like where do you think you're going to find most of the opportunities?
I think we'll see it everywhere. In the last week, I saw a $9 million apartment on Central Park South that I could have bought for $4.5 million. We haven't seen 50 cents on the dollar type deals for a long, long time in Manhattan. I've seen a lot of multifamily, particularly in Class B and Class C, the less upmarket type properties, and single family homes all over the place. Downtown, rural, semi-rural. We're going to see it everywhere. No one gets out of here. There's no place where you're going to get out of here with just no with no pain to soldier through. Overall, house prices are doing just terrific thanks to low interest rates, and we're seeing people refinancing like crazy. That's fine. The problem is going to be the bottom 20% of the economy. Those people who are just barely hanging on and have been just barely hanging on for 6 or 7 years. This will be the straw that pushes them into non-performing on their mortgage, and that will mean that loan will need to be restructured.
Yeah, I think it's an interesting phenomena. It's that you can have this large segment of the economy, population take a big hit, and then this other large segment almost go in the opposite direction, which maybe that's where this is headed. Eventually, you would think that part of the economy and those people that do get hit the hardest, that's going to be a drag on everything else. You would think it's somehow all connected, like it can't be completely separate.
Well, eventually it catches up, right? The lower income consumer is generating the revenue for a lot of the higher paid jobs. And when their income is gone, then the higher paid jobs revenue is gone too. And it will play out over time. It just won't happen, in one quarter. If you look at the crash of 2008, property prices started to fall in late 2007, but they didn't hit the bottom until 2011. So this stuff takes a while to play out. It doesn't just happen overnight.
Yeah, and in different areas, I know had different amounts and different timelines within all of that. So it's going to be spread out over time and be complex for sure, and no one's going to know overnight or even in a few months.
Right.
It's probably not till you're looking at in the rearview mirror that you can maybe start to understand fully what happened.
Yeah, everything is obvious in hindsight.
What would if you were the small, call it small, but real estate investor out there that maybe does a flip every now and then or owns a couple of rental properties, what would you be doing to protect your current investments, and what opportunities would you be looking for?
I think that the key thing is to make sure you're supporting your current tenant and making sure that if they are in a job that's a sustainable job, make sure you don't lose them, because it will get harder to keep good tenants. There's going to be plenty of rental properties available as soon as the eviction moratoriums are lifted, which I think is in most places is happening in the next few months. And then I just watch for deals. I mean, I think there will be distressed sellers. So if you want to buy actual real estate, there's always a deal. I don't think there's been too many deals, and it depends on what market you're in. But I'm just looking here, national realtor data out today, house prices up 5.2%. So I don't know. It seems odd that the number of people out of work is at a record high. We've got businesses shuttered across the country, and real estate prices are going up. That seems odd to me.
Yeah, I think we're probably seeing in a lot of spaces that kind of there's like two different economies out there, and at some point they'll potentially collide. But you've got this one group that is doing well and is able to take advantage of low interest rates and inflation, right? The government's pumping trillions of dollars into the economy, which is probably you would think that's devaluing the dollar and therefore driving up the prices of things like real estate. So the people that have the ability to take advantage of low interest rates in a high inflationary market, potentially, like they're gonna benefit up until the point, I guess, where the collapse of the bottom part of the economy like drags drag them down as well. But it seems now that government policy is almost fueling this kind of bifurcation of two different economies.
Yeah, I think it's a thankless task to try and be in the Fed or the Treasury right now, because there's very little demand in the economy, and anything they do seems to make the rich richer and is having limited impact on those who struggle to make ends meet. But consider the alternative. They could do nothing and we would have 1929 all over again. So I don't think anyone wants that. So we just soldier on as best we can. And I think that will mean that there'll be some bubbles, and it may be in real estate, or it may be in the stock market, or it may be somewhere else. But I would just say now is a good time for great caution, rather than going crazy with buying more assets. And if you have a mortgage, it's a great time to refinance. I think we're at all-time low rates right now. So if you can get debt and you think your tenant is a good credit risk, then now's a great time to refinance.
Yeah, I agree with that. I think lower your fixed costs if you can, lower your rates. Look for opportunities if you see them, and if you are gonna buy, like I would definitely make sure you have proper reserves, right? Just make sure you can withstand not having rent, because at the end of the day, prices are going up now. That could change. Like, none of us have a crystal ball, but as long as you don't sell, as long as you're not forced to sell, you're not gonna lose your shirt. So I think,
and I think that's
make
the
sure
key.
you're not putting yourself in a position where you'd have to sell.
That's the key. This is not the time to be aggressively buying, in my opinion, because who knows what's around the corner. The future is always uncertain, of course, but it's particularly uncertain right now. So I think a bit of conservatism is not a bad idea. I also think that you're right. We will get to inflation at some point, and we're seeing it maybe in real estate right now. But again, who knows?
Well, this has been really fun, Paul. I've learned a lot. I'm pretty sure our listeners have too. Before I wrap up, I'd like to do the HyperFast round if you are ready.
Ready.
All right. So just some rapid fire questions and answers. what's the biggest piece of advice you would give to a new real estate investor right now?
Learn everything you can possibly learn before you spend a dollar buying real estate.
That's a great one. What's the biggest challenge you've ever had in business, and how did you overcome it?
When we started the business, we scaled way, way, way too fast. I bought one loan, and then 3 months later, I bought 10 loans. And then 3 months later, I bought 250 loans. And then I bought about 500 loans. So by the end of my first year, I had over 1,000 loans. And it was ill-advised, because the systems, habits, and practices that we had in the organization were too immature for the number of assets that we bought. And it was just firefighting constantly for about 5 or 6 months. And you don't want to be doing 100-hour weeks for 5 or 6 months just to keep the wheels on the truck. And planning, it's not the plan, it's the planning. And I just hadn't got a good plan. We just went way too fast. And it took 6 months of brutality to get the train back on the tracks. But never, ever, ever, ever give up. Just put your head down and keep pushing. And yeah, I made some mistakes, but none of them were terminal. So that's the main thing.
Yeah, I mean, you at some point you have to learn by doing, and that's gonna lead to mistakes. But if you can at least position yourself where they don't take you out, then when you get through it, you'll be that much better, which seems like you've certainly done. What do you think is a mistake that experienced investors make? And you just talked about this a little bit potentially, but when they begin to scale, so maybe they have success on the first deal, second deal, but now they want to get to 10 or 20, like what's a mistake that most people make that maybe if someone like you advised them on, they wouldn't?
I think most real estate investors are entrepreneurs, and entrepreneurs are optimists. And optimism can be your friend to get you started, but it can also get you in all kinds of trouble. And if you're optimistic about your pro forma economics, everything comes in more expensive, and rent comes in less than you thought, and everything takes longer. And so your pro forma economics don't work anymore. And I would just say, as you're scaling, you need to be conservative, have very strict deal box. We have a very strict deal box. We only buy certain types of loans. And you can come to me with other types. I'm not even going to look at them because we don't buy those. We're the best at one small thing, and that's all we do. And the beauty about this fantastic country is you can specialize in something and do nothing but that thing and still build a terrific business with it. Most countries don't have that opportunity.
All right, if you're not doing a real estate deal, buying a loan, what would we find you doing?
In winter, I ski badly and break things. Usually my shoulders. Last year, one shoulder. Year before that, a finger. Year before that, ribs. So I ski in winter, and I love the beach in summer. So you'll find me swimming. I do about a mile every morning in the ocean, which in Dublin Bay, which is currently about 52 degrees, that is quite cold.
Yeah, I can't imagine it's ever too warm there. So that's pretty impressive. Where do you see yourself? Last question, by the way. Where do you see yourself in 5 years?
I think I can build a competitor to the municipal investment funds that produce 2 or 3% a year for investors, and we can produce 8% a year for investors, and with a comparable amount of risk for the return. And I think we can really scale that, and that's what I'm spending the other 20% of my time doing right now.
Well, Paul, it's been a pleasure talking with you today, and I know you mentioned it before that you're able to deliver these returns to investors, and then the minimum is quite small. Before we sign off here, do you want to just tell people a little bit about the investment opportunity you have, where they can
Yeah,
find it, and then how they can connect with you on social media or whatever you use to connect with people?
sure. It's a SEC Regulation A fund. You'll find all the details, the prospectus on the SEC website, or you can find it on our website, automationfinance.com. We buy mortgages and work with the borrowers to get them paying. And so far, we've paid 8% every month to all of our investors. We haven't missed any payments. We haven't lost any capital. But any investment obviously has some element of risk, and you should definitely read the prospectus before considering investing. We pay 8% a year, and we pay it monthly, and that's our target return. And we've been doing that since 2014. And if you want to contact me, you'll find me on LinkedIn, Paul Birkett, or you'll find me in the show notes right here, I guess.
All right, well, connect with Paul on LinkedIn, and you can check out Automation Finance and his funds. Reg A, which means I think most people can invest in it, correct?
Anyone with $250 to invest can get involved.
Yeah, so very, very low threshold. Usually these kind of deals, you got to have a lot more money. So that's awesome. And I highly recommend you guys listening to this, reach out to Paul, and please do us a favor, by the way, if you like the show, if you got value out of it, leave us some comments, leave us some reviews, share it with other people that you think could benefit, because we want to help and reach as many people as possible. And thank you for being on the show today, Paul.
It was an absolute pleasure, Dan. Thanks so much.
All right, and everyone out there listening, we'll see you next time. Thanks for tuning in.
Hey guys, thanks for sticking around to the end. If you want to see more videos like this, click right here. And if you're new to the channel, click below to subscribe and turn on post notifications so you don't miss out. And let me know in the comments what you think about the videos. I'll see you next time.